Cash account or margin account? What should you choose? How does margin affect you? What is the PDT rule? How to short a stock on a cash account? If you're looking to open a brokerage account or you already have one, stay with me in this video to find out the answer to all of these questions and more. Welcome to my channel. I'm Mike and this channel is about my journey going from $10,000 of my own cash up to $80,000 in 3 years. In today's video, we'll look over my most recent profits, I'll explain my trades for this week, and I'll share with you my opinion on cash versus margin account. Like the video now, ask the questions later in the comment section below. Let's get into the trades. Last week, I closed 6 trades with a total profit of $800. Since in my last video I discussed about the risks of shorting puts, I decided to take my own advice and I exited NVTA before their earnings date. This was a high-risk trade, not in line with my overall strategy. I would need to look at NVTA for the next, let's say, 2 to 6 months, read their financial reports, and then decide whether I want to trade them or not. Fortunately, I managed to get out of the trade with a small profit. I remained with Palantir's $25 strike and RKT's $20 strike puts from my previous weeks of trading. These contracts expire in March. I took somewhere around $800 in premium, but I will gladly close these positions anywhere above 50% in profits. My $800 to $1,200 monthly target has already been reached for February, so the rest is just a bonus. The more I exceed my target, the faster I get to pay down the loan. If you haven't watched my strategy video and you have no idea what loan I'm talking about, you can check it out in my trading challenge playlist. For this week, I had 3 trades. I received $900 in total premium, but more than 75% of that was nano dimensions. Let's look at the charts and then we'll discuss the cash versus margin accounts. First trade of the week was AMD. Again, this time I sold $188 strike put until the 26th of February. I received $114 for it. I am confident of AMD's long-term growth and also at the $90 support level. On Thursday, AMD dropped below my $88 strike, but I had no fear. Worst case scenario, this trade will get rolled over a few times like I did on my previous AMD put at $90 strike price. This will expire next week and I'm looking to close it above 60% of profits. My second trade was Nano Dimensions. This is a more speculative trade, but the price movement on the 16th of February gave me courage. Nano Dimension announced a public offering at $12.8. As you can see on the chart, on that day the stock went as low as $14 but never dropped to $12.8. This is a bullish sign if a company's dilution doesn't drop the stock to the offering price. In the next 2 days, Nano Dimensions traded somewhere around the $13.5 support level. I sold 4 contracts for the 19th of March at $12.5 strike and received a total of $688. I'm looking to close my position anywhere above 40% in profits. My last trade was SNAP. I'm searching for a short put opportunity on SNAP for at least 2 months now. This week I got my chance. When the S&P 500 was negative, SNAP was not. They had earnings and didn't drop. Although the current valuation of SNAP is not ideal to me, the price movement is. I sold 2 contracts for next week at $58 strike and I have received $122 in premium. On Friday, SNAP had a pop towards all-time highs and it seems like it's preparing to break out. I don't really care if it does or it doesn't, but I care that my put contracts are already valued at half of the premium I paid. I look to close this trade somewhere around 70 to 80% profits. Now that this week's trades are over, I'd like to ponder on Palantir for a second. Based on the chart, it seems like I've entered my $25 strike trade with a bad timing. I was expecting a different move during earnings, but apparently the move was influenced by the expiration of the lockup period on approximately 80% of the shares outstanding. Palantir dropped on the lockup expiration date all the way to $25. It seems that the support I considered at $25 took its role seriously, and Palantir bounced back on Friday all the way to $29. I'm not considering closing this trade yet, since my entry price was not the best. In my previous videos I discussed about my trading strategy, about my 1% weekly target on cash secured puts or my 3 to 5% weekly target on margin. What does that mean? Let's start with the basics. Whenever you open a brokerage account, the basic one is a cash account. That means your buying power is 100% correlated with your cash. For example, if you have $1,000 in your account, you can buy 1,000 shares of a $1 stock or 1 share of a $1,000 stock. But you cannot buy, for example, Shopify, which is currently trading at about $1,400. If you choose a margin account, your broker might provide you with a 2-to-1, 4-to-1 or even 6-to-1 leverage. In my case, Interactive Brokers offers a 4-to-1 leverage on the margin accounts. That means that for each $1,000 cash I have in my broker's account, I am able to buy stocks for up to $4,000. Again, an example. With $1,000 cash in my account, I am able to buy one Amazon share, which is currently trading at more than $3,000. Up until now, for the Dave Ramseys that are watching this video, the cash account is the way to go. But for the Wall Street Bets fans, the margin account is the one account to rule them all. Let's take a closer look at these account types and compare them. A cash account has a settlement period. That means you cannot use your cash until it is settled. This applies for both deposits as well as trading. Deposits usually take 3 days to settle once your broker has received your funds. Stocks, for example, have a T+2 settlement date. That means it takes 2 days after the day of the trade for that cash to settle. You can't enter a new trade with unsettled cash because you might get banned by your broker. For example, let's say you have $1,000 in your account and today you buy $500 worth of stock and you close it the same day with a $50 profit. That means for today and tomorrow your available cash to trade will only be $500 because the $550 is considered unsettled cash. Options, on the other hand, have a T+1 settlement date. That means you can use the proceeds from a trade only the next day. If you have a margin account, you will not be impacted by the settlement period. That doesn't mean it does not exist. It's just that your broker will take on the burden of settling that cash, while you have all the available funds at your disposal. What is the PDT rule? PDT stands for Pattern Day Trader. When you trade on a margin account with less than $25,000 in total equity, you are allowed to make only 3 intraday trades on a rolling period of 5 days. The PDT rule only applies to margin accounts and only to US-based brokers. One of the perks of having an Interactive Brokers account after the Brexit is that I no longer have the PDT rule limitations on my margin accounts. But if you live in the US or the UK and you trade with Interactive Brokers, you will have the PDT rule in place. Cash accounts don't have the PDT rule, but as we have discussed previously, your cash needs to settle before you can use it again.
You win some, you lose some.
When it comes to shorting stocks or options, you can't do that in a cash account. You can't borrow shares for shorting and you cannot trade naked short calls or unsecured short puts. Also, you can't trade any other complex option strategy. But if you think a stock will go down in value, you can simulate a short position by buying a put contract. Also, buying a put contract is safer than shorting the actual stock, since your maximum risk is the amount you paid on the contract. Most brokers will have no minimum requirements when opening a cash account. You can deposit $100 or $1,000 or $10,000. Either way, you can trade with that cash once it is settled. But when we're talking about a margin account, major brokers in the US ask for a minimum of $2,000 to maintain your margin account. The cash account limits your risk to your cash. You can't lose more than that. Unfortunately, with a margin account, you can lose all your money and also still be indebted to your broker if you don't know what you are doing. Having a margin account with a 4-to-1 leverage does not mean you should use your leverage. It doesn't mean you are forced in any way to trade on margin. You can trade with your cash only and still have a margin account. This is for you to take advantage of a possible short position from time to time, or maybe complex option strategies, like iron condors for example, or simple debit spreads. Oh, I almost forgot. When you trade on margin, that's not free. Each broker will charge some annual rates when you are trading on margin. I've made some research and I have to say, Interactive Brokers is by far best in class when it comes to margin rates. If you look at this table, I think you'll understand why I say that. TD Ameritrade has an annual rate starting from 9.5%, depending on the size of your portfolio and the used margin. E-Trade, Tastyworks and Webull are somewhere in the middle. They have rates ranging from 7% all the way up to 9%. Best brokers for margin trading are Robinhood with a 2.5% rate and Interactive Brokers with 1.57%. Now that we went through the pros and cons of margin and cash accounts, let me know in the comments below what type of account do you have. Do you think of switching from a cash account to a margin account or the other way around? As you might already know from my previous videos, I currently have $20,000 in my broker's account, $10,000 of my own money and $10,000 from a bank loan. My weekly target is to sell premiums for 3 to 5% of the collateral required by the broker for each transaction. When you sell puts in a cash account, the broker holds collateral equal to the strike price times 100 shares. Looking at my, let's say, RKT $20 strike put, one contract requires $2,000 of collateral in a cash account. But in a margin account, the broker asks for a lower collateral. The formula is this one. In my case, for the RKT $20 strike put, my current margin requirement is somewhere around $500. So if I divide my received premium of $120 to the margin requirement of $500, I have a 24% premium versus margin. And that's for a 4-week trade. That's an average of 6% per week. If I were to extrapolate this to my whole account, for $20,000, I could sell 40 contracts of RKT $20 strike put. This means approximately $4,800 in premium for a 4-week trade. This kind of trade is extremely risky. Trading with 100% of your account on margin is a certain road to blowing up your account and owing money to your broker. I cannot emphasize enough that you should never trade this way. My strategy stops at 50% of my margin account and I limit the contracts per trade to the same equivalent cash. For example, on RKT, I wouldn't enter with more than 5 contracts at $20 strike. If I were to get the stock assigned to me, I would need $10,000 in cash to cover that trade. For a $50 stock, I will normally go in with 2 contracts, and for a $100 stock, I will go in with 1 contract. So, when I'm saying I have a 3 to 5% target of my margin account, what it really means is that my target is 3 to 5% out of $10,000. I am looking to profit anywhere between $300 and $500 per week. That's the sweet spot I chose for my strategy. Thank you for sticking with me up to this point. If you enjoyed this video, please hit the like button. It helps my channel grow and shows this video to other people interested in the subject. If you want to get notified when I post new videos, you can click the subscribe button and the notification bell. If you have questions or any opinions about my strategy, please share them in the comment section below. Thank you for watching and have a great trading week.